Yeah, good morning.
Good
Yeah, we are
morning.
welcome. We are welcome to today's class. So today we'll be moving to a new topic, which is withholding tax. So, so we'll be moving to withholding tax today. So I hope. So let me see. I hope everybody has joined so that they don't. Okay, that's good. Okay. So as I said, we'll be looking at withholding tax. So majority of us will have been, especially those of us that are working. So we will have heard about what? The tax withholding tax. So this withholding tax is not a different type of tax. Like under the tax, we have what? Direct and indirect, which we have what? Personal income tax, we have company income tax, we have the hydrocarbon tax, we have the value added tax, custom duty, and some other taxes. But this withholding tax is not another form of tax like our personal income tax or the company income tax. It is simply an advance payment of tax. That is what that is deducted at source from payments made to a third party, which will be remitted to the relevant tax authority. So what do we mean by this withholding tax? It's simply an advance payment of tax that is deducted at source from payment that is made, which will be remitted to the relevant tax authority. So because government are of the opinion that there are certain transactions that if taxpayer are allowed to enter into such transaction, so those transactions may not be declared by taxpayer. For instance, as an individual now, if you are an individual, you are in paid employment, and for you to be in paid employment, that means your employer will be deducting your pay on a monthly basis, which will be remitted to your internal revenue of your state of residence. So because you are an employee now, that employee, let's say that employee is blessed with excess fund. That employee now invests the excess fund in fixed deposit. Investing that money in fixed deposit, the bank, anyway, there's going to be reward for that deposit, which will be interest. So do you think that if that person receives that interest, because government know that by the time the taxpayer receive that interest, the taxpayer is not going to declare that interest to his employer as additional income. So that is the reason why this withholding tax is being introduced, which will be what? So that means by the time they are paying you that income, the amount of tax on that income will be what? Will be deducted. And any amount that is deducted is not a waste to you. It's going to be available to you as what? As a set-off against your what? Against your subsequent tax liability. So in essence, so government introduced this withholding tax to avoid what? To avoid the process of what? Tax evasion and what? And tax avoidance that are usually what? That are usually embarked upon by tax payer. So this withholding tax has been in existence for a long time. So in which what your tax will be deducted at source. But in 2024, another regulation came up which began operation in January 2025, which is what the 2024 withholding tax regulation, which is the regulation guiding what guiding the practice of what of withholding tax. So whenever a withholding tax is suffered, so any amount you suffer will be what available as what as a relief by the time you want to pay your tax liability or in subsequent year of assessment. So that is just what you about this withholding tax. But there are also some withholding tax that are not going to be available as a relief. So you may not use them to set off your tax liability. Such withholding tax are regarded as well frank investment income. So which we are still going to talk about what in subsequent explanation. So what are now the features of this withholding tax? Features of withholding tax. Payment of withholding tax is statutory on the person making the payment. So it is not an excuse. So before now, no excuse that please, I forgot to deduct the withholding tax. Why you forgot to deduct the withholding tax? Before the withholding tax regulation, both the amount you forget to deduct and the interest on that amount will be what? You are going to be held responsible for the payment. But now the tax law has been redefined. So when you fail to deduct withholding tax, so you are going to be liable, you are going to be charged with a penalty for not deducting. So what that means is that one of the features is that payment of withholding tax is statutory. So it is compulsory on the person making the payment to deduct withholding tax. Then number two, withholding tax credit is usually used to offset tax liability. So as I said earlier, it's not another form of tax. You are going to use it to reduce your subsequent tax liability. So that is another form of. So it is an advance payment of income tax which are utilized as tax credit against income tax liability of the year in which the income relates. So it's also used to offset tax liability. Withholding tax represent the final tax on frank investment income. So there are some instances that you may not be allowed to use it as a set-off. So those instances, those income are called frank investment income. So basically, what are the types of withholding tax? Types of withholding tax. So there are basically two types of withholding tax. We have the withholding tax payable and the withholding tax claimable or recoupable. It can either be called claimable or recoupable. Withholding tax payable and claimable. So those are the two types or category of withholding tax. In the first instance, we have withholding tax payable. Withholding tax payable. Withholding tax payable. So this withholding tax payable, these are the withholding tax deducted from payments made to a third party, which will be available as a set-off by the third party. So withholding tax deducted from payment made to a third party by a taxpayer. So it can either be by either a company or by a taxpayer who is an agent for withholding tax. So this withholding tax now is what? Payable is what? The amount you deduct. The amount you deduct as an agent from payment you are making to what? To a third party. So that amount you deducted, you will be what? It's expected that you remit it to what? To the relevant tax authority, which will be used as a setup by what? By the third party. So from where? From the relevant tax authority. And this amount, after deducting, is expected to be remitted within what? Within certain time limits. So that is for what? So this withholding tax payable. So a good example. So let me give an hypothetical example like withholding tax payable. Let's say we have what? So we have equity professionals now. We know equity professional is a tuition house. They are engaged in what? In providing what? Lectures. Financial ICAN tuition is an ICAN tuition center. So they provide what? Lectures to students. Their lecture ranges from both what? The online student and what? And the physical student. The physical student, they have what? They have premises. They have premises that they make use of to receive their lecture. So let's say, for instance, equity professional engage, they want to repair some item within the premises that are used for the physical lecture. So they now engage the services of, let's say they engage the service of a particular vendor, Mr. Kunle, who happen to be what? An electrician, to help them what? To fix some light, which should be what? Which should be used during what? Lecture. So there's going to be what? An agreement between what? That contractor, which is Mr. Kunle, and equity professional. So let's say they now enter into agreement that, okay, help us fix the fan in all our classroom. We are going to pay you the sum of 1,000 naira, for instance. So it is expected that after the completion of the job, or whenever equity professional want to pay Mr. Kunle, equity professional is mandated to deduct certain amount before paying him that 1,000. Any amount they deduct in form of tax is what is called what? Withholding tax. So that amount will be withheld, will be what? Deducted by what? By equity professional on behalf of what? The relevant tax authority. On a normal day, if let's say that 1,000 naira is the contract value, so they now end up paying him, they now deducted 50 naira. So that means they are going to pay Mr. Kunle 950. So that 50 naira that is being withheld by equity professional is what is called what? Withholding tax payable. And this withholding tax payable, it is not what? It is not equity professional money. They are just keeping it for what? For the relevant tax authority. It is expected that what they must remit it to the relevant tax authority within what? Within the stipulated time. So that money now, that 15 naira, by the time equity professional now remit it to the relevant tax authority, Mr. Kule can now use it to reduce his own tax liability. So that amount of 15 naira is what? Is withholding tax what? Payable to what? To equity professional. So that is how to what? To know withholding tax payable. And this withholding tax payable, as I said, you have a time limit to pay it. It is at every financial year end, at the end of the accounting period, it is expected that what? Every taxpayer, whether company or individual, that is engaged in business must what? Must keep record of their transaction. If at the end of the financial year, this amount, this withholding tax is yet to be remitted to the relevant tax authority, where at the end of the year, they are yet to remit it to the relevant tax authority, it must be stated because it is not their money. It is money they are owing on behalf of the tax authority. They must also what? They must record this somewhere. So where they are yet to pay it at the end of their financial year, it will be stated in their what? In the statement of financial position as a what? As a current liability. Take note of that. It is stated, it will be stated in the what? Statement in the company, statement of financial position as a current liability. As what? As money they are owing. So that is for what? For the withholding tax payable. So which is what? Which is expected to be what? To be remitted to the relevant tax authority. After that, we also have the second category of withholding tax, which is what? Withholding tax claimable. Withholding tax claimable. So this withholding tax claimable, that is the withholding tax suffered from payment received from another party. So when you are receiving, the first one is when you are making payment, you deduct. Now, when you are also receiving money, as a receiver of money, the person who is paying you that money is also expected to deduct. So when you are, so the withholding tax you suffered from payment you received from a third party is what? Is the withholding tax claimable. And this, so for instance, the same scenario, we also have equity professional, which we know is what? Is an ICAN tuition house. Let's say equity professional, they also need to what? So somebody being an ICAN tuition house, they also provide what? Financial lectures. Let's say a company now engage their services, the services of equity professional to what? To educate, to lecture their staff on what? On certain accounting what? accounting topic. So they want them to what? To give lecture to their staff on certain topic relating to what? Accounting. So that means money is going to move. So let's say the name of the company is XYZ Limited. So that means XYZ Limited is going to pay equity professional at the what? At the completion of what? Of the contract. It is also expected that before XYZ pay equity professional, XYZ must also deduct withholding tax from the money they are going to pay to equity professional. That money that is being deducted by XYZ before making payment to what? Equity professional is what is called what? Withholding tax claimable to equity professional. And it will not be what? Withholding tax payable to what? To XYZ Limited in this scenario that I just gave now. So at the end of the financial year, it is also expected that what? Where the money, that money now is expected to be what? To equity professional is expected to use it to what? To reduce their tax liability. Where at the end of the year, they are also yet to what? To claim it as a relief from their tax liability. So it must also be what? It must also be stated in their account in the what? In the statement of financial position as a current asset. So they will also state it as a current asset. So what this means is that what? A taxpayer can have both what? Withholding tax payable and also what? Withholding tax claimable. So according to the tax law, please, the tax law does not allow set off between what? Between the withholding tax payable and the withholding tax claimable. So the tax law does not allow where a taxpayer is having both withholding tax claimable and withholding tax payable. Tax law does not allow you to remove them from one another. They are expected to be what? To be stated separately. When you have withholding tax payable that is yet to be paid, at the end of the year, state it as what? Current liability. When you have withholding tax claimable that is yet to be claimed at the end of the year, state it as what? As what? Current asset. So you are not expected to what? To settle. That is, if you want to, let's say for instance, we have a withholding tax payable of 50 naira, and we want to claim 100 naira from government. So don't say because I want to claim 100, I want to claim 100 naira, and I want to pay them 50, I want to remove my 15, the 15 I'm supposed to pay them from the 100 naira, then I will now be left to 15 naira. No, that is not allowed for withholding tax. You can only do that under what? Value added. But for withholding tax, is not allowed. You cannot what? You cannot set what? Set off what? The transaction between what? Withholding tax payable and what? Withholding tax claimable. So any questions so far? Any questions?
Yes, sir.
Okay, I'm
Okay.
with you.
Good morning, sir.
Good morning.
Sorry, this withholding tax claimable and the withholding tax payable. I'm a little bit confused, especially the claimable.
Okay.
Yes, can you help me clarify? And the percentage.
We are here to get to the percentage. I just use that as an illustration.
Okay.
Withholding tax claimable. Those are the withholding tax that is suffered. Look at that word, suffered from payments received from another party. The one you suffered. Payable is the one you deduct from payments you are making. Now, when you want to receive payment from another person, the one you suffered from payment you are receiving from another person is what is called what? Withholding tax claimable, which is like the example I gave, which is what? Between equity professional and XYZ. So XYZ is going to pay equity professional. So before XYZ pay them, XYZ is expected to what? To withhold a withholding tax. So that amount withheld by XYZ to equity professional is what is called what? Withholding tax claimable. So they call it what? Claimable. It's the one you suffered. Whenever you suffered any withholding tax as a taxpayer, so that amount of withholding tax you suffer is what? Withholding tax claimable. But when you deduct as a taxpayer is what? Withholding tax payable. Is it clear now?
Eh,
Thank you, sir.
Yes, I have a
Clear.
question too. Are we
Okay.
are we expected to deduct withholding tax from every transaction?
Yeah, there are certain transactions that attract withholding tax, not all transactions. So we are still going to talk about it. So there are certain transactions that when you go into those transactions, you must deduct. Not all transactions. There are
Okay.
some that does not attract. Like, for instance, if your employer is paying you your salary now, your employer will only deduct pay. So it's not expected to deduct another tax, which is withholding tax. So not all transactions. So there are certain category of transaction. Any other question? Okay, let us proceed further. So we also have what is called a refund of tax, as I said. So you may also, where you have a withholding tax claimable, so that means it is expected that you use it as a set-off against tax liability. And when you don't, when you are a particular taxpayer that is exempted from tax, there are some taxpayers that are exempted from tax, maybe because of their nature or because of the industry they are. So maybe they have a pioneer status or some other status. So they may be exempted from tax. So the fact that they are exempted from tax, where they engage in transaction with another person, that person will deduct what? Will deduct withholding tax before what? Before paying them. So what that means is that they may have what? Withholding tax claimable that they are unable to what? To use as a set-off. So where they have that, the tax law has mandated what? The relevant tax authority to what? To refund such what? Such taxpayer within what? Within 90 days. So refund of what? Of withholding tax can be made within 90 days once it has been what? Once it has been fully established, but that's what? That such taxpayer is entitled to what? To a withholding tax refund. So this is according to what? Section 63, subsection 7 of what? Of SITA. So a refund of withholding tax. So then this refund can be in what? In any form, can be what? Can be in cash or it can be what? Through credit system. So but if there is no credit system, it's expected that what? They must refund you or back your cash your money within what? Within 90 days. After it has been established that what? That is what? You are entitled to what? To the refund. So, and how will it be established? That means what? A thorough what? Tax audit or investigation will have been what? Will have been conducted by what? By the relevant tax authority. And the tax authority will be satisfied that what? There is what? There is a refund of what? Of the tax. So after that, 90 days, so you are expected to what? To claim back your what? Your withholding tax. Then what are those? So if I have a withholding tax now that has been deducted, where do I know where to remit that withholding tax from? Because we have various relevant tax authority. So do I just wake up as an agent and say, okay, I'm going to remit it to this? So withholding tax remittance depend on what? On the what? On the nature of the taxpayer. So who are those administration of what? Withholding tax. So where the payment is deducted, where the withholding tax relate to payments made to companies, when you are making payments to companies. So please, the withholding tax on that is remitted to what? To Federal Inland Revenue Service. So withholding tax on payment made to company is remitted to what? Federal Inland Revenue Service, to FIRS. Then withholding tax on payment made to individual, enterprise, partners in a partnership business, unincorporated companies, then and also trustee in a trust and settlement, all those categories, their withholding tax are remitted to the state of the resident of the individual. Withholding tax of the state internal revenue service of the resident of the individual. Withholding tax state internal of the resident of the individual. Then withholding tax deducted from payment made from the resident of FCT Abuja, so anybody that's a resident of Federal Capital Territory, Abuja. So such withholding tax are remitted to FCT Internal Revenue Service. So we have what is called what? Federal Inland Revenue, FCT, Federal Capital Territory Internal Revenue Service. So that Internal Revenue Service is an internal revenue service under FRS. It's also part of FRA, but it's an internal revenue service that was established is under FRA. That is meant to cater forward for those individuals that are residents in what? Federal Capital Territory, Abuja. So they pay their own to FCT IRS under what? FRA. Then the withholding tax on payments deducted from residents, from members of what? Of Nigeria Armed Forces. So the members of the Nigeria Police Force, members of the Nigeria Foreign Service, all those are payable to a Federal Inland Revenue Service. So members of the armed forces, member of the police officer. So if you are deducting any withholding tax from payments you want to make to them, it will be payable to a Federal Inland Revenue Service. Because so federal government is the one that paid what their salary. Then withholding tax on payments made to non-residents. So non-resident, whether individual or company. So a company will be regarded as a non-resident where that company is not what? Is not incorporated in Nigeria. So they don't have what? The CAC. So they don't have CAC. They say they are not incorporated or registered in Nigeria. Such companies are regarded as what? As a non-resident. So where an individual does not stay in Nigeria for a period of 183 days or more, so such individual will be regarded as a non-resident. So withholding tax deducted from payment made to non-resident, whether individual or company, are remitted to the Federal Inland Revenue Service. So basically, those are the administrator of what? Of the withholding tax. Both the State Internal Revenue Service of the 33 states and FCT, and what? And the Federal Inland Revenue Service. So what are now these? Somebody asked earlier, so now to that. So what are now those income or transactions that are subject to withholding tax and the rates? So income and transactions that are subject to withholding tax and the rate of such income. So income transactions that are subject to withholding tax and their rates. Please, this rate will not be provided to us by the examiner. It is expected that we know this rate. It is expected that we know this rate. So we are expected to know this rate that we have for each category of withholding tax. So before the new withholding tax regulation, which I said came up in 2024, which started in January 2025, which is the withholding tax 2024 regulation. Before then, we usually have the same rate for both resident and non-resident. But now the withholding tax rate has now been streamlined into resident and non-resident for both company and for individual. So they are now being grouped into different forms depending on the nature of the taxpayer. Therefore, dividend, the first category of dividend and interest. For dividend and interest for all category of taxpayer, whether company and individual, and the nature of their residency, the withholding tax rate is 10%. So for dividend and interest, any form dividend and interest, whatever the form of the taxpayer, the rate is 10%. Then royalty, for companies, whether resident or non-resident, the rate is 10%. While for individual resident, the rate is 5%, and for individual non-resident, the rate is also 5%. So basically for company, we have 10%, and for individual, you have 5% for royalty. Then we have rental fee when you receive rent, when you are paying your landlord rent. So the landlord rent is not the one not the one as you paying your landlord, but when an agent is paying landlord rent, so It's going to deduct withholding tax on rent, hire for hire, whether you hire of motor vehicle, hire of equipment, hire of plant, and what lease payment. So the withholding tax for all category of taxpayer is also what 10%. So I mentioned hire of motor vehicle here or hire of. So this is not when you engage with the service of what of Uber. So don't go and say because your lecturer told you that okay, when if I hire motor vehicle, I'm supposed to deduct withholding tax. You now want to deduct from a Uber man. No. Hire of motor vehicle in the sense that there are some companies that what they do is what? That is their major business. They provide a fleet of cars. So they are engaged in logistics services. So when you hire motor vehicle from them or any equipment from there, so you are expected to deduct withholding tax from before making payment to them. Then we have a commission, consultancy, technical. So like our audit fee, management and professional fee, audit fee. For company, resident 5%. For company, non-resident 10%. Individual resident 5%. Individual non-resident 10%. Then we have a supply of goods or, or material other than by what? By the manufacturer or producer. So where you are making supply, where the person making that supply is not what? Is not the person who is what? Who is not the producer of that goods. Because where you are the producer, that sales will constitute, that goods you are supplying will constitute your major sales. Which one? Which should be liable to what? To the your applicable tax, either what? Company income tax or personal income tax. But where you are making supply and where you are not the manufacturer or producer, so that is only related to what? To resident resident taxpayer. So for resident company, we have 2%, and for non-resident, we also have what 2%. Before now, supply of goods it was initially what at 5%. So it was the withholding tax regulation that now what that now changes now to what to 2%. The rate now is now what 2%. So this was reduced in order to what to make what because they find out that a lot of taxpayer they usually what have a lot of what withholding tax claimable as a result of what as a result of a higher rate. So that was why what the rate was reduced to what to 2%. Then collation and telecommunication tower services. Companies that are engaged in what telecommunication activity. So we have for what resident company 2%, non-resident 5%, resident individual 2%, non-resident 5%. Supply or rendering of services. When you are rendering services, so when you are rendering service, if you are a resident taxpayer, the rate is 2%. If you are a non-resident, the rate is what 5%. So for resident taxpayer. Construction of road, bridges, building, and power plants. Construction of road, bridges, building, and power plant. For resident in taxpayer, 2%, and for non-resident, we have it as well, 5%. So any other form of construction and related activity. So where the construction does not relate to road, bridges, building, and power plants, it is only this four that is having this rate. For any other form of construction, and any form of construction or related matter. For residents will be what 5% for both individual and corporate, while for non-residents will be what 10% for both corporate and individual. Brokerage fee, brokerage from insurance companies. So when they are paying you brokerage or from any activity you enter into, 5% for what for resident, for company, 10% for non-resident, and 5% for resident individual, and 10% for non-resident. So director fee, you can see under director fee, for the company, we have one not applicable, NA. So the tax law is that what? As a director of a company, a director cannot, you must be what? You must be a person. The director of a company cannot be what? Cannot be what? An artificial person. You must be an individual. So that's why you have the rate for individual. And as a director of a company, it is expected that even though we are the director of a company are companies, where it is company that buy another company, there are people that owns the company. So those people who owns the company will be regarded as what? As people who receive the director's fee. So director's fee is only applicable to individual taxpayer. For resident individual, 15%, and for non-resident, we have it at 20%. The compensation for loss of employment, we have it at what? Also for individual, when you lost 10% for both resident and non-resident. Entertainment and sports person. So these people, they are what? These people are, this one, you see entertainment and sports person. This relates only to what? Non-resident, you can see. Because the government find out that all those foreigners, they just fly to Nigeria to come and do entertainment, to come and sing. After singing, after engaging in those singing, they will collect a lot of big money. They will be paid big money, and they just what? They just go away with those money without what? Without paying any tax on those money. So as a result of that, government they also want to collect from where? From the non-resident. So when you come into Nigeria to come and what? To come and provide what? Sport, to come and entertain or to come and engage in sport activity, you're also liable to withholding tax as a non-resident. For company, 15%, and also for individual, 15%. Then we also have a winning from lottery, gaming, reality, and show. So we have it as well. Individual, so 5% for what? For resident and what? 15% for non-resident. Please, as I mentioned earlier, this rate will not be given to us by the examiner. It is expected that we know this rate. So some rates will be provided for like the capital allowance, but withholding tax rate and usually not provided by the examiner. So the examiner expects us to know what the rate that is applicable to what to each transaction, both for resident and non-resident company and individual. So with this now, this will settle what the person who asked the earlier question about what about. So is it all transactions that we attract withholding tax? So you can now see those transactions that withholding tax are chargeable on. So those are the transactions that attract withholding tax. Any question?
Yes, sir. I have a question, sir.
Okay.
My question goes like this, sir. Like based on what you said about withholding tax, man, and then I know withholding tax is always charged on goods bought from maybe a manufacturer like that. What of like the 2% now? Like you mentioned about like the construction of maybe road or bridge now. Is it like the
Yeah.
2% is it going to charge on their profit, accessible profit at the end of the year? That's what I'm
No,
confirm,
no, no,
sir.
no, 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 not on the profit. This withholding tax they want to charge is going to be charged on the contract value.
So,
On the
okay, sir.
contract amount, the contract, how much is the contract value? Because by the time you want to, they don't know how much is your It is after you have prepared your accounts that you are going to determine your profit. But as at the time you are entering into that transaction, you don't know how much is the profit you are going to make from it. So the rate is going to be based on that contract amount.
Okay, sir.
Yeah.
And then also, let's say for instance now, someone wants to collect a contract from the, let's say, federal government or another parastatal like that now. Okay,
Okay.
they're not going to charge the amount like that. Like, okay, they want to give a contract to person, or is the person during the time of the calculation? That's what I want to confirm, sir.
I didn't get your question.
Okay, let's say that for instance now, we want to collect a contract from Lagos State government now, for example now.
Okay. Okay.
And let's say the contract is 20 million naira. Are they the one
Yes.
going to charge the amount that okay, so withholding tax?
Yes. Yeah, they are the one on that 20 before. So that means if the contract value is 20 million naira, they are not going to pay you the full 20 million naira. They will deduct withholding tax from that 20 million. It is the balance of that after the withholding tax that they are going to now pay you.
Okay, sir. Thanks so much,
Yeah.
sir.
Yeah. Any other question?
Yes, I do. For contract staffs in company, can we
Okay.
categorize them under this service of 2%?
Yeah. The tax law before now, tax liability for individuals. So contracts are you that is relating to individual staffs. Individual taxpayer are liable to personal income tax. Before now, the tax law is only relating to what? Permanent staff. But the tax law has now group tax, personal income tax to be liable on whether you are what? You are a permanent staff of a company or you are a temporary staff of that company. So where you are a staff, where you are working for a company as a staff, whether you are permanent or you are temporary, what you pay is what? Is payee personal income tax and not withholding tax. This withholding tax is only relating to those that are not what? Employee, but they only come and what? Render service to what? To the taxpayer. Is that clear to you?
Okay.
Yeah.
Sorry, sir.
Any other question?
Sir, hello, sir.
Okay.
Hello,
Hello?
Hello.
sir.
Can you hear me, sir?
Sorry. Hello,
Hello?
sir. Hello, sir.
Uche, Abi? Let Uche
Yes, sir.
speak first.
Okay.
Okay, oh yeah.
Okay. Sir, for companies that are non-resident and they're not registered under CAC, obviously they
Yes.
don't have a tax identification number. How do we now remit withholding tax to them to FRS?
The fact that, okay, good question. The fact that a company is not registered, so does not mean that they don't have TIN. There's a difference between TIN number and CAC number. Where you are not registered, so that is when you will not have our what? The CAC number. But you must what? Register with what? The relevant tax authority for what? For the purpose of tax, because what? You are doing business in Nigeria. So you are going to register with the relevant tax authority for the purpose of tax. So you are not going to, so all that means that you are not registering with CAC. You will only register with what? With our relevant tax authority, which in most cases will be what? Federal Inland Revenue Service. What will now come to our mind is that it is possible that some company will now, they may decide that, okay, wait, I'm not even going to register sales. Maybe it's just for me to what? To supply this person that I want to supply, and the person will pay me. So where the company is a company that is not registered, but is doing business in Nigeria. So that person they are engaging in business with must what? Must deduct the withholding tax on behalf of the relevant tax authority and remit it only in the name of what? Of the taxpayer. So you are going to use their name to what? To remit to what? To the relevant tax authority. So are you clear with that?
Yes, sir. I'm clear.
Yeah. I hope somebody wanted to ask the question again before. Who was it?
Hello,
Someone
sir.
wanted. Okay.
Yes, actually, I was the one that wanted to ask that question. Thank God that
Okay.
she asked the question. I think I'm
Okay.
clear now.
Okay, you are clear. Okay. So any other question? So those are the transactions so please take notes. So the examiner is not going to give you those rates. You are expected to know those rates. So please let us take note of that. So we also have transactions that are exempted from withholding tax. So one of them is across the counter transaction. So one of the transactions that are exempted from withholding tax is across the transaction. So what do they mean by across the transaction? Instead of, so you wanted to buy something now. Instead of now telling somebody to supply you, telling a contractor to supply you. So what you do is you went to the market yourself to go and buy that item by paying what? In cash and on cash basis. So after seeing the transaction, you pay immediately. So that means what? There is nobody that supply you that item. So that is what across the counter transaction. So where you are paying for that transaction outrightly in cash. So you enter into where they are selling it and you buy that transaction. So they are not going to deduct withholding tax because to the company, that is what? That is their normal sales. So that is what they are talking about here. Supply of goods or material other than by what? The manufacturer or producer. So that is the one they are talking here. So across the counter transaction. So I just go to the manufacturer straight away to go and buy without telling them to supply. That is exempted from withholding tax. Then goods manufactured or material produced by the person making the supply. So where the manufacturer is the one supplying. So because that will constitute their normal sales. The imported goods where the transaction does not create a taxable presence in Nigeria for the foreign supplier. So there are some foreigners, non-resident that what they are not liable to what Nigerian tax due to what due to double taxation agreement between what Nigeria and their country, or due to the nature of the transaction they are providing to Nigerian citizens. So where that item is an imported item that is not liable to tax. So that means when you import those items, because that person is not liable to pay Nigerian tax. So that means that tax will not be that transaction will not be liable to withholding tax. Interest and fee paid to Nigeria bank by way of direct debit of the fund which are domiciled in the bank. So you have two banks, bank A and so belonging to you. You now transfer from one bank to another. So they now pay you interest because it's still between the same bank, between the same person, or you are paying between one bank and the other. It is still within the same bank. So any interest between them is not going to be liable to withholding tax. Then income or profit exempted from tax. So where they are exempted, no withholding tax. Out-of-pocket expenses that is normally expected to be incurred directly by the supplier and is distinguishable from contract fee. So expenses that relate to buying that item directly out of pocket. So buying the item, I also will not attract withholding tax. Claim in insurance business. So when you receive insurance claim will be received as a result of premium that the insured pay to the insurance company. When the peril, when the loss now occur, it is mandated on the insurance company to compensate the insured. So when any compensation you receive from an insurance company is what is called claim. So that claim that is received from the insurance company, so when the insurance company are paying you that claim, they are not going to deduct any withholding tax. Why? Because that claim is collected as a result of you paying what? Premium to what? To the insurance company. Then supply of what? LPG, CNG, PMS, any form of petroleum products. Supply of any form of petroleum product does not attract what? Does not attract withholding tax. That has been what? Specifically stated by what? By the tax law. So any form of petroleum product, whether gas, diesel, CNG, or any form, so does not attract what? Withholding tax. Any distribution or dividend payment to a real estate investment trust or as provided under. So distribution you are making to or dividend payment to real estate. Under part of the transaction that attract withholding tax is what? Dividend, which we talk about here. Dividend and interest, 10%. So any dividend you are now paying to a real estate investment company is not going to attract what? Withholding tax payment. So which is what? Any distribution or dividend payment to a real estate investment trust or real estate investment company. So any dividend you are paying to their shareholder is not going to attract what? Withholding tax. Because that dividend you are paying to them, that money you are paying to them is as a result of what? Doing real estate business, trading business, which the rental income will have what? Attracted what? Withholding tax before the customer, before the occupant pay them that rent. Then compensating payment under a registered security lending transaction. So any payment from a lending transaction is also exempted. Commission retained by a broker from money collected on behalf of the principal in line with your industry. So a broker, so stock exchange business. So the commission that does not belong to the broker, but is commission for the insurance company, but it's just retained by the broker for the purpose of the business. It's also not going to be liable to any form of withholding tax. So winning from a game of a chance or a reality show with content designed exclusively to promote entrepreneurship, academic, technological, or scientific innovation. So when you are winning from a game of show, content, academic, technology, to develop those areas, it's not going to be what? To be liable to withholding tax. Then regulatory fee paid to government agencies. So for company now, so they have what regulators. Banks, they have what CBN as their regulator. There are certain fees that are paid to them. For some companies that are also listed on the stock exchange, we have what Stock Exchange Commission SEC as the regulator. They also pay certain regulatory fee to them. All those fees paid, by the time you want to pay it to the government, so it's not going to what attract what withholding tax. So because what? Because it's also going to what to the government cover. So those are the what transactions that some of the transactions that are exempted from withholding tax. So the list is endless. So we also have some that are also not listed as part of this list. But anyone that is not part of this one that is having rate will be exempted from withholding tax. Then we also have a contract of supply. So contract of supply, they try to define it as well. All forms of supply, delivery, or the like through competitive bidding, LPO, other arrangement, whether or oral or written. This time does not cover the across counter cash sales. I explained across the counter earlier. So contract of supply is what? When there is what? An agreement between what? Between the supplier and what? And the customer. So there is you enter into an agreement that okay, you are going to supply me this so item, and there is an agreement between us. That will be what term contract of supply. And contract of supply does not mean what when you go to a company now to go and buy. So across the counter, it's not part of a contract of supply. So that's what they mean by what contract of supply. And what? So this contract of supply. So under this contract of supply, you may give rise to what? There may be what we call what? Sales in the ordinary cost of business, which they mean by what? The across the counter transaction. So this sales in the ordinary cost of business are transactions that will not attract what? Withholding tax. So and in order to determine whether a transaction will constitute sales in the ordinary cost of business. So the following rule we need to what? We need to be follow by the what? By the tax authority or by the law. So one of the rules is that what? The inclusion of the transaction activity in the object of the memorandum of association. For there to say, this transaction is part of the normal activity of a company, that transaction must be part of the what? Part of the objective and the object of what? Of the association, of the memorandum and article of association of a company. When a company is being floated, that's what is called memorandum and article, which will state what the company is expected to do. So that thing must be stated as part of their activity before they can say that is what their normal says. Then the nature and the practice of the taxpayer, business and the industry. So what is the nature of the business? So to that particular transaction. So the history of the taxpayer in relation to the activity. Is the taxpayer conversant with that activity or is just a one-off activity? And the frequency of the type of transaction. So the frequency, how often does the taxpayer engage in also a one-off transaction? So that will consider whether the transaction is carried out as the normal transaction, which should be regarded as across the counter transaction that will not be what. Then we have what is called the principle of what double taxation relief and the rate of withholding tax. So basically, withholding tax here, we stated here that withholding tax here for dividend. We stated here that withholding tax, I stated for dividend, interest, and royalty. Dividend, interest, and royalty. For resident, look at it. Dividend for non-resident 10%, non-resident individual 10%, non-resident company 10%, non-resident individual 5%. It was stated that the withholding tax rate for non-resident for these three category of transaction will be what? Will be 10 reality. So government, they also need to what? They also need to encourage foreigner to come and invest in Nigeria. Come and invest in Nigeria is what? By reducing what? The withholding tax rate. So government now find it magnanimous to what? To reduce certain withholding tax rate to 7.5%. Only relating to what? Dividend, interest, and royalty for companies. You know, for those transactions, the withholding tax rate happen to be what? Happen to be 10%. If you look at it here, for company, non-resident, 10%, 10%. So where the non-resident, that company is a non-resident company, and that company, the country where that company is resident is having what? A double taxation agreement with Nigeria. Where there is a double taxation agreement between what? The country of resident of that company and Nigeria. The withholding tax rate to be charged on what? Those three categories of income, on dividend, interest, and royalty will be what? 7.5% instead of what? Instead of 10%. This is only applicable to what? Non-resident. So why does government introduce that? That is being introduced in order to what? In order to encourage foreign investment. So foreign invest in what? In what? Dividend, to come and invest in company, to come and invest in what? It has what? In fixed deposit to get interest and what? To also what? Invest in form of what? Getting royalty. So where it is company, the withholding tax rate will be reduced. Non-resident individual, the withholding tax will be reduced to 7.5% for dividend and interest and 5% for royalty. So that is only for what? Non-resident company, where the company of resident of that individual, where they have what? Double taxation agreement or treaty with what? With the Nigerian government. So they must have what? Double taxation agreement or treaty with the Nigerian government before what? Before that what? That rate can be what? Can be adopted. Instead of now using 10%, the rate that will be the rate of their withholding tax will now be 7.5% and 5% for what? Individual, non-resident, in the case of what? Royal. If I enter into a transaction now, you and I, do we have right to what? To deduct withholding tax? So that will now lead us to what? Deduction of. Basically, before those who are expected to deduct withholding tax are regarded as what? Agent of deduction. Agent of deduction of withholding tax. They call them agent for withholding tax. Why? Because they are acting as agent to the relevant tax authority. They are acting as agent to the relevant tax authority for the deduction of what? Withholding tax. So that is the work they are doing. So they will act as agent to the relevant tax authority for deduction of withholding tax. So these agents now can be any of the following. For the following purpose, the required deduction of withholding tax on liable transaction. So can be any of the following: a body, corporate, Don't need. A body corporate or individual, which is not what incorporated. So what this means is that what a company that is what that is registered for the purpose of a business, whether that company is what is liable to tax or not. So a company may be exempted from tax, but that does not exempt. So those that are expected to deduct withholding tax are what? A body corporate, that is a body. So any company that is any corporate that is registered as a company, whether you are what resident or non-resident, and what unincorporated, or if you are an individual that is what that is engaged in business. If you are an individual that is engaged in business other than an individual, look at that word, a body, corporate, or unincorporated. That means anybody that can deduct withholding tax are what? Anybody that is engaged in business that is regarded as a body that can either be what? A company or an individual. This word unincorporated means what? Individual. Other than what? An individual. So where an individual that is not a corporate, so that means an individual that is not engaged in business cannot deduct withholding tax. So what that means is that what you and I, that we are not engaged in business, that what we only do is what? We are engaged in what? Paid employment. We cannot what? We cannot deduct withholding tax. So that, in essence, what that means is that what? You cannot tell your landlord that, Mr. Landlord, before I pay you my rent, you have told me that rent is liable to withholding tax. I'm going to deduct certain amount of money from your rent. No, because what? You are not obligated to what? You are not an agent for deduction. It is only those that are what? That are doing business, either as a company or as an individual, that can what? Deduct withholding tax. Also, a government ministry or department, government ministry or department can also what? Deduct withholding tax. A statutory body like a club, or any form of statutory body, non-NGO, a non-governmental organization, they are also mandated to deduct. A public authority, public library, or any form also, they can also deduct. Any other institution, enterprise, or organization, including those exempted from tax. I mentioned this earlier. The fact that an entity is exempted from tax does not exempt it from where? From deduction of withholding tax. They are also going to deduct withholding tax. A payment agent in respect of those mentioned above. So anybody that is acting as an agent for any of these people. If you are acting as an agent for any of these party, you are also mandated to what? To deduct what? Withholding tax from what? From any payment you are making to what? To any party. So failure to do that, you are going to be is an offense in the what? In the tax law. So the law now proceed further. Small business making less than 25 million annual turnover are exempt from where? From the requirement to deduct or remit withholding tax, provided the supplier from which the small business ought to withhold tax have a valid TIN number and the transaction value with one supplier does not exceed 2 million in a calendar month. We have companies that are regarded as small companies. So those are companies with annual turnover. Look at annual turnover of 25 million naira and below. Where a taxpayer, whether a company or an individual as a taxpayer, is having an annual turnover of 25 million naira. You are in business, your turnover is 25 million naira. In a year, at the end of your accounting year, the total sales you made is what? 25 million and below. You are regarded as what? As a small business. So those business, by law, you are not expected to deduct withholding tax. You cannot deduct and you cannot remit withholding tax according to the tax law. But there is a condition to it, provided that the person you are what? You are transacting with is having what? A valid tax identification number, provided that the person you are dealing with, you are doing business with, is having what? A valid TIN number, and what? The transaction between you and that person does not exceed 2 million naira in a calendar month. In 1 month, the transaction you are doing with that person, with that supplier, does not exceed 2 million naira. Where the transaction exceeds 2 million naira, so the fact that you are a small company, you must also what? Deduct. The transaction must not be more than 2 million, and that taxpayer must also have what? A valid TIN number. Where the taxpayer does not have a valid TIN, you are mandated to what? To also deduct withholding tax and remit it in the name of what? Of that taxpayer. So what that means is that in effect, individual and organization not listed above cannot what? Deduct withholding tax when making payments. So by law, you and I that are not engaged in business, we cannot what? Deduct withholding tax. So let us take note of that. So we cannot deduct withholding tax from any
Hello,
of
sir.
those payments where we are making any of those payments. Yes?
Hello, sir.
Okay.
Sorry, by an item E, any other institution, enterprise, or organization, including those exempt from tax. And I will not see number two is a small business making less than 25 million as turnover
Yes,
are exempt from the requirement to
yeah.
deduct or remit withholding tax. So I'm a bit kind of confused about that.
Yes, there are some companies. It is not only small businesses that are exempted from tax. There are also some businesses that are exempted from tax due to their nature. For instance, where a business is being given a pioneer status, there is what we call pioneer status. That is you are investing in certain sector. For investing in those sector, by law, you'll be exempted from tax for certain period of time. So that does not mean that what your turnover is 25 million and below. You have a turnover of more than 25 million, but because of the requirement of the law, which has exempted you from paying tax, so that does not exempt you from deducting withholding tax. So they are not talking of small company there. They are talking of a company that are also big, but due to their nature and the form of activity they engage in, they are exempted from paying taxes. So that is what that word is telling you. Is that clear?
Okay, thank you. Thank you. Thank you.
Yeah. Any other question? So after we have deducted this withholding tax now, so what is the remittance nature of this withholding tax? So any payment you deduct from where? From companies. So that will be, or from individual, or any payment that is due to, any payment that is due to the Federal Inland Revenue Service. It is expected to be remitted within 30 days. To be remitted within 30 days. Remitted within 30 days. When the payment is due, is otherwise settled, or the day the payment is made. So 30 days within when the amount due is otherwise settled, or the date the payment is made. There are two words there. Within 30 days when the amount due is otherwise settled, or the date the payment is made. So you may have entered into a transaction and say, okay, we are going to pay you in the next 1 month. Maybe that next 1 month happen to be 10th of June, for instance, 2025. Maybe before that 1 month, the company is able to get that fund. They decide to pay before that date. So where they pay before that date, that means what? The withholding tax will be due within 30 days from when the amount is otherwise settled. That is when what they mean by what? When the amount is otherwise settled, or the date of the payment is made. So that means the payment is supposed to be made as at what? As at a particular date, which is what? The date they agree, which is 10th of May. But they have already paid before that date. So since the payment has been made before that date, the withholding tax payment become due from that date that that payment is otherwise settled. So that is what. So 30 days forward for payment that is due to Federal Inland Revenue. So where the payment is due to State Internal Revenue, so you have within 21 days to make the payment to the relevant tax authority within 21 days between when the amount due is otherwise settled or the date the payment is made, whichever is earlier. So you must make the payment either within 30 days or 21 days, depending on on the relevant tax authority. Then in the case of payment due between related party, deductions have been made at the time of payment or when the liability is recognized, whichever is earlier. So related party between a parent company and a subsidiary. So where the transaction is between them, so the withholding tax will become due. So you are going to be counting the date from the date when the payment is made, when the liability is, or when the liability is recognized in their book. The amount deducted from a non-resident taxpayer shall be regarded as final tax, except where the income is liable to further tax due to taxable presence in Nigeria. So what the tax law is saying is that where a taxpayer is a non-resident taxpayer, so that means they are not going to pay any other tax. They are not going to be liable to company income tax in Nigeria. So they may not be liable to personal income tax. They may not be liable to it because they are non-resident and they don't have They don't have taxable presence. So where the only tax they are going to suffer in Nigeria is withholding tax. Withholding tax is the only tax they are going to suffer in Nigeria. So what that means is that that tax they suffered, it is final in Nigeria. So they will only use it in their country of residence as as a relief. So they cannot use it in Nigeria to set off any tax liability. Why? Because they don't have any other tax to pay in Nigeria. So the only tax they are liable to pay in Nigeria is the withholding tax. In that case, so that withholding tax will become final tax in where the taxpayer is a non-resident. Then we have some offenses that have been introduced to the new withholding tax regulation, which have been redefined. So offenses, the regulation tend to mandate all supplier to have tax identification number. Transaction involving recipient supplier without a TIN will attract twice the standard withholding tax rate. Note this information. Where you are dealing with, as an agent for withholding tax, you have the right to deduct. You are mandated to deduct. Where you are dealing with with a taxpayer who does not have a TIN number. So because that taxpayer does not have a TIN number, if you want to pay that tax, for instance, you now want to pay that taxpayer dividend. You know the rate of dividend is Is 10%. It is mandated that by law that you are going to You are going to charge withholding tax rate of 2 times that particular rate. Why? The reason is because that taxpayer does not have a tax identification number. And since the taxpayer does not have a tax identification, it is possible for government not to Not to cash up with that particular taxpayer. So they decide to collect larger percentage of tax from him in form of withholding tax. So that procedure will also force some taxpayer that does not have tax identification number to visit relevant tax authority to register, because they will want to avoid being charged higher rate of withholding tax. So one of the rule is that when you are dealing with any taxpayer, whether resident or non-resident, who does not have a tax identification number, it is expected that you charge 2 times 2 times the rate of the tax that is stated as the withholding tax rate. So where the rate is 10%, you are going to charge 20% because that particular taxpayer does not have a tax identification number. Then the next one is customer that pay vendor in full. Yeah. So it is also expected that, okay, you have a right, you are an agent for withholding tax now. You are expected to deduct withholding tax. But instead of you to deduct, you now pay them in full. Before now, what the law normally do is that what? You are going to be liable for both what? The amount of the withholding tax, the penalty, and the interest. The law has now been redefined to now what? Is now relating to what? Only this. So customer that did not deduct withholding tax but pay their vendor in full will be subject to administrative penalty and annual interest at the prevailing monetary rate of CBN, as opposed to the current practice of what? Requiring such customer to also pay the withholding tax. Before this regulation came up, if you are expected to deduct withholding tax and you fail to deduct, it is expected that by the time tax authority now they now get hold of that transaction, you are going to be liable for the amount you did not deduct. You are also going to pay interest. You also pay penalty. But now the law has been redefined. Where you are expected to pay, but you fail to pay, the withholding tax amount is not your own problem. You are not going to be charged the withholding tax amount, but they are going to charge you administrative penalty. You'll be subject to administrative penalty and what? Interest at the prevailing what? CBN, commercial interest at the prevailing what? Central bank monetary policy rate. So that means the amount of the withholding tax is no longer your own what? Your own cup of tea. But they will charge you what? Penalty on that for not deducting, and also charge you what? Interest at what? At the prevailing what? Commercial rate. So they will now run after what? After the taxpayer that you fail to deduct to go and collect what? The amount of what? Withholding tax from him. Then any person or body corporate being obligated to deduct tax as such, fail to deduct or having deducted, fail to remit such deduction to the relevant tax authority within the stipulated time frame shall be guilty of an offense and liable to an administrative penalty and annual interest rate at the prevailing interest rate plus the what? Plus the amount of the. So where you have deducted withholding tax. Instead of you to remit, you now fail to remit. You are going to be liable to what? To an administrative penalty and what? Interest at the what? Prevailing what? Commercial bank rate plus that amount that what you deducted. So you are going to be liable to what? 3 things, which will be what? Amount you deducted, interest at the prevailing commercial bank rate, and what? And penalty, administrative penalty. So note that companies are required to submit the electronic form a schedule of their supplier for the month, showing the tax identification number, address of supplier, the nature of transaction, withholding tax deducted, and what? An invoice number. So these are what just a schedule that will be submitted to the relevant tax authority. Then we also have a currency of deduction. Withholding tax are expected to be deducted and remitted in the currency of the transaction by law. Where a transaction is carried out in foreign currency, by law, that transaction is also expected to be what? To be deducted and remitted to the relevant tax authority. But the process of remitting is that what? You are going to remit that money through what? Through the Central Bank of Nigeria so you remit it through the Central Bank of Nigeria. So it is the Central Bank of Nigeria that will now change it to what? To the Naira equivalent and transfer it to what? To the relevant tax authority account. So you are not expected as an agent for withholding tax to what? To act as what? Bureau de change to what? To the relevant tax authority. If we have the transaction for withholding tax, where the transaction is done in foreign currency, you are also expected to deduct it in foreign currency and what? And remit to what? To the relevant tax authority through what? Through the CBN. So the CBN will now effect what? The necessary what? Payment by what? By converting what? To the Naira equivalent to the relevant tax authority. That is for withholding tax. Then we have certain income that are regarded as a frank investment income. I made mention of it when we started. So those are income that any tax you suffered on them are regarded as a final tax. Any tax you suffered on them are final. You cannot use it to set off your subsequent tax liability. So any tax you suffered on them are what final tax. They are what they call them a frank investment income, which are not going to be any withholding tax suffered on them are not going to be available as a setup. They are regarded as a final tax, which should be what? Which should be borne by what? By the taxpayer. And is the only example of frank investment income is what? Dividend. So dividend is a frank investment income. So what this means is that what? Dividend is only liable to what? Withholding tax. So they are not going to be liable. So any withholding tax you suffered on dividend is final. You are not going to use it to claim your tax liability. So in essence, so whenever you are preparing for tax liability, so where dividend is stated as part of the income given to you, it will be what? It will be stated as a non-taxable income, because what? It is a frank investment income. So there may be a scenario whereby this frank investment income will be recouped, will be recovered back. You know, we said you cannot use any tax you claim on it as a setup, but there may be a scenario whereby you can set off the tax that you paid on it. So that is according to Section 80, subsection 3 of CETA. So Section 80, subsection 3 of CETA stipulate that dividend received shall be treated as frank investment for the company receiving it, and shall not be charged to further tax as part of the profit of the recipient company. Yes. However, where such income are redistributed and tax is to be accounted for on the gross amount of the distribution, the company can set off the withholding tax payable from the withholding tax claimable. What this means is that you collected a dividend. By the time you collected that dividend, the dividend will have suffered tax before you collect it. In which what you will have withholding tax claimable. That same dividend that you collected, you now redistribute it. It is that same dividend that you redistributed. Instead of you to put it in your business, you redistributed that same money to your what? To your shareholders in form of dividend again. The dividend you are collecting from another company, you now redistribute it to what? To your shareholder as well as a dividend again. So that means that same income, that same money is going to give rise to what? To two categories of withholding tax. It's going to give rise to both withholding tax payable and the withholding tax claimable. So what the law now says is that what? Where that occurs, you have a right to what? To set off the withholding tax claimable from the withholding tax payable by law. So you can set them up. So that is only available for what? Frank investment income. Where the frank investment income is being what? Redistributed. Is what? Redistributed. So you can set it up against what? Against one another. But where there is no redistribution, so the frank investment income cannot be set up against one another. Any tax you suffered on it is what? Will be what? A final tax, which will not be available as a setup against what? Against subsequent tax liability. So what are now the difference between this withholding tax and value-added tax? So value-added tax is an indirect tax which is on consumption, while withholding tax is a direct tax. It is imposed on goods and services, VAT. Withholding tax is imposed on income at source. As you are before you receive the income, the withholding tax will have been deducted. Value-added tax is at a flat rate of 7.5%. So withholding tax rate depend on what? On the type of transaction. Depending on the type will determine the rate. The value-added tax is backed by VAT Act 2004. Withholding tax is governed by CETA, Company Income Tax, PIT, and the Withholding Tax Regulation of 2024. VAT is governed only by the FRS, but for the withholding tax, it is governed by both the state internal revenue and the federal inland revenue service. Then VAT is shared among the 3 tiers of government, while withholding tax is shared by what? So VAT is shared by the 3 tiers of government, while withholding tax is not shared by what? By the 3 tiers of government. So what you collect as a government agency belongs to you. What federal government collect belong to them, and what state government collect also belong to them. It is not shared among the various government agencies. So that is for withholding tax. So any question?